All right, well, it was an eventful third quarter for investors, but nothing fired up the bears quite like the repo market chaos that broke out in mid-September. We had overnight lending rates spiking above the Fed's target range for the Fed funds rate. Now, the Fed stepped in to participate in repo transactions for the first time since the crisis. The Fed will be involved in the repo market at least until October 10th, though it kind of seems like this is now the new state of play. And investors really want to know why the New York Fed seemed so flat-footed when they dealt with this problem. Brian Cheung joins us now to discuss. So Cheung, we're kind of bouncing off a journal story out over the weekend, sort of detailing new New York Fed President John Williams, who everyone knew was not experienced with financial markets before he joined the New York Fed, and what has kind of happened under his watch. I think there's two arguments here. The one could be, well, regulations created this situation where eventually the repo market, the Fed's going to have to participate in the repo market again. On the other hand, I think the subtext of that story was like, well, if you hadn't hired John Williams, then we wouldn't have had this problem in the first place.
Yeah, well, okay, so I mean, to kind of back up, we need to go to 2 weeks ago, which is when the liquidity crisis kind of happened in the repo markets. It was a Monday night into a Tuesday where rates were spiking up as high as 10%. I mean, some broker-dealers in the space, banks, were paying up to 10% for overnight funds when the target federal funds rate at the time was between 2 to 2 and 2.25. And there were arguments to what degree the New York Fed should have provided the repo facility before rates spiked up that high. And I think that's kind of the question that's at hand here. Did the New York Fed know that this was coming, and why didn't they react fast enough to make sure that the repo spike didn't happen in the first place? And this gets at the operational question of what John Williams, again, the president of the New York Fed, should have done and how much on the radar it was kind of seen for the Federal Reserve officials to actually do something. Yeah. The problem here is that it wasn't that the New York Fed didn't know what to do. They did know that the answer to this was putting together that temporary
liquidity,
right, to provide liquidity through the temporary repo facility that they did not open until 9:15 on the morning after repo rates had already spiked up to 10%. So the problem is that the Fed officials have said publicly that they knew that there was going to be this crunch because of the corporate tax receipts, because of the high Treasury issuance. But regardless, the New York Fed didn't provide the repo facility until after the rates had already spiked higher. And the Wall Street Journal article, in addition to an interview that he provided to the New York Times, hinted that, look, we were watching this, but that we just did not see that the pressures were going to be as high as they were. Yeah. That might be covered because, hey, we just, we don't want to look like we've got egg in our face because we missed this. But I think a second thing that Fed officials are saying is that we've fixed it since, because rates have since come back towards their target range.
So if you look at Williams' quote in there, he says that this, meaning basically the temporary patch, the coming in to fix the system, this is what the Fed does best. Or I think he said this is the Fed at its best, right? I mean, I think Williams views the Fed as a problem-solving institution. But I guess, Jared, from just the mechanics of one, like the Fed, so the Fed has to come in with billions of dollars to make these repos, transactions clear, basically, right? Mm-hmm. These are requests for money, and no one had the money. And then the Fed came in and said, we got it. They put their hand up. I guess, to your mind, what does this say about where the Fed is in relation to the actual functioning of financial markets? Because a lot of people have been very upset with how this has gone down the last couple of weeks.
I think the Fed, especially the New York Fed, is a bit rusty here. It's notable that the head of their markets group formerly was Simon Potter. He was there during the QE guys. He stepped away in June. They used to have Brian Sack. Anybody who covered this stuff 10 years ago knows these names. They were in the trenches, and they know these facilities and the markets and how they operate. The New York Fed should have been dusting this off and issuing trial runs. They already do that once or twice a year, but they should have tested it. And it's notable that when they finally started it on Tuesday morning, the first auction failed. And that's another red flag. So yeah, they were caught flat-footed. They've caught up now. The auction this morning was for $100 billion. I think $62 billion was claimed. So there's enough liquidity to cover quarter end and month end here. And I think they'll fix it going forward. But it doesn't make me that confident that they would be able to handle a surprise. In other words, can they get caught flat-footed again? Yeah, probably.
Now, an issue that came up during the last press conference with Jay Powell was that now there's going to be organic balance sheet growth again. Mm-hmm. Some people believe this is QE4. I guess, Brian, as you see it, and there's been a lot that's happened in Powell's fairly brief tenure, but it does seem like this might be the legacy of the Powell Fed, is like under the Powell Fed, everything was going fine, and then they tightened the balance sheet, or they pared the balance sheet pretty aggressively, and with no intention of changing that. And that's really where they had to reverse course. And now we're back to this permanent, this standing facility again.
I think that so far the Powell Fed's biggest challenge has been the communication. I mean, this was no surprise. We saw, I believe it was in the June press conference where things got really crazy. And, with Powell, a lot has happened, to be fair.
Yeah.
I mean, this is not kind of the period where rates were low. We knew that it was going to be zero, and each press conference was just the same thing being said over and over again.
It's not the Yellen Fed.
It's not the Yellen Fed. During the course of 2019, we have seen such a paradigm shift in Fed policy because of not necessarily anything to do with Powell, because the trade issue from the White House has been the biggest thing that the Fed's been trying to navigate so far. But when we talk about the balance sheet, there is a serious concern about even just the semantics of how you're going to describe it if the Fed were to announce in October and December that it was going to resume balance sheet growth again. I mean, like FinTwit was just, they went ablaze when it was like, oh, do we call it quantitative easing or not? Well, your definition on quantitative easing, is it really just about the volume of it relative to the size of the balance sheet? Is it about the speed to which they would purchase some of these assets? Is it about the type of assets that they purchase? I mean, it's like this existential question of what is
POMO.
what.
Very safe. Call it a POMO. But nobody knows that is.
Right. Yeah.
Right.
Permanent open
market.
market operation.
Yeah. So I don't know. It'll be very interesting to see as we get to October. And the thing is, like, what kind of average person knows what a standing repo facility is?
Well, I think that's
right? I mean,
that's what has always amazed me about this is, so this happened, as you noted, on a Monday night into a Tuesday. But like by Thursday, it was like mainstream news was like the Fed is cracking. And it's like, well, I mean, is the Fed cracking, or is the Fed now using basically made up money to make the market clear, which is, I mean, to me, that's what they're doing.
There were reports on, they're trying to save some failed institution, somebody big in the market's failed. You can't really say that without betraying your misunderstanding of how these things work, but there were a lot of stories out there.
Yeah.
If anything, it sowed some confusion in the market. I think it's been largely cleared up by now, but again, as the Fed has to do more and different things, and some of the same things that they did prior, people are going to be writing the same stories.
Just quickly, I mean, it's kind of interesting to see how it was almost a replay of kind of the early stages of QE and QE1 when we were talking about this repo issue, because it got people who not on the fringe per se, but people who don't usually pay attention to these things to start dialing in. And there was a real challenge, I think, in the financial press in explaining to people what's going on here. And I think that, not that if we get to another recession that this is going to be related to the same issue, but I think that the financial press is really kind of becoming cognizant that the definition of quantitative easing, the definition of repo facilities and kind of liquidity in the underplumbing of this market will be really critical to how we kind of.
It's really fun for us, though.
Yeah. And another thing it comes back to too is like, you just realize anytime you say since the crisis, people just lose their minds. And I wonder how, I mean, it's been 11 years now. I wonder how long that goes. Like, is it 30 years from now that we say since the financial crisis and people lose their minds? Because that to me was really like the trigger.
I mean, everyone's super sensitive about it, but I think once everyone flocked to this repo story, it was really apparent to at least me. It was just like, this is something that a lot of people don't have their arms wrapped around, even though we assume especially on this show, sometimes we just assume that everyone understands the underpinnings of the Fed.
Everyone's familiar with the fractional reserve system. I mean, come on.
It's not that hard.
Yeah. All right. Inside money, outside money. No big deal.
Exactly.
All right. Brian Cheung will talk to you tomorrow. Thanks for stopping by.